Yes, I did just become president of the board, but that just only indicates one thing. They finally did get to the bottom of the barrel. It was either me or the guy who delivers lunch, and we don't even get free lunch anymore because Andy Duboff spent all the money from the board when he was president. The state of New Jersey's broke, Andy. Thanks. So how does a guy from New Jersey, formerly born and raised in Philadelphia, wind up at the West Regional meeting? Well, I actually come from Southwest Jersey. Does that work? Well, not really. The fact of the matter is Ray Johnson's granddaughter is graduating from high school, and so when we were at our last peak meeting, he was asking me somehow, some way, could I come and take his place? And I said, well, I probably won't really take your place, but I will go to New Orleans and try to give everyone an update on what's going on with respect to changes in ethics. And that's what we're going to talk about today. Before I even begin, though, there's a couple of people in the back, and they are really key individuals who make Peak tick. And I think it would just be wrong not to at least make mention of them and ask them to stand up or raise their hand. And that would be Lisa Snyder, who's the director of the Professional Ethics Division of the AICPA, Lisa. And her cohort, Jason Evans, a Temple University grad, but other than that, he's a real good guy. Senior Technical Manager of the Professional Ethics Division. There's obviously a whole slew of people that make Peak tick, but another person is Ellen Goria. And Ellen was kind enough to provide Ray and I with two programs that we were able to use to put this presentation together today, so I have to give her credit as well. So let's talk about what's going on with changes in ethics. There's a lot of stuff that's happening at Peak. I've been on Peak now for 3 years, and I'll never forget my first meeting. It was pretty intimidating. The amount of information I had to read beforehand, and I kind of went in thinking, oh my goodness, what did I get myself into? But there's been a number of projects, not the least of which is the Codification Project that have been ongoing. So we picked a couple of, Ray and I picked a couple of the, or a few of the more prominent issues to present to you today. Obviously, time would not permit us to go over all the different projects that Peak is encountering at this point. So if you take a look at the slide over here, obviously I've already discussed the codification report. Revisions to 1013 for non-audit services. This is an area, from my vantage point, it looks like, especially with some of the smaller practitioners, is an area where I don't think there's 100% compliance. So there's been some changes made to maybe make it a little bit easier for licensees and members to comply. The next area is holding out as a CPA. There's been some significant changes there. Requests for client records, in my experience with the State Board of Accountancy in New Jersey, that is always an area. I would say it's one of the top reasons for consumer complaints, at least it is in our states. Subordination of judgment, there's been some recent changes to that particular topic. Partner equivalence and client affiliates are somewhat related to independence, and we'll spend some time towards the end just going over those as well. So let's start with the Codification Project, which is an ongoing, it seems like it's been, at least since I've been on Peak, we've been talking about the Codification Project. And finally, on April 15th of this year, the exposure draft was issued, and that we're currently in the comment period until August 15th. The idea here was to rewrite the code to create a user-friendly, more intuitively arranged code that's separated into three major groups. First group being for members in public practice, the second group for members in business, and then the third group would be for all other members. This was all done with the notion of enhancing the clarity of the code, making it easier to research. I know in my particular firm, I happen to be the ethics compliance partner, so I'm constantly being asked information with respect to the code of conduct. Hopefully with the new code, maybe some of the folks will be able to look these things up on their own instead of bothering me, but it's never really a bother. But the whole idea was the notion of enhancing the clarity of the code with a minimal number of significant changes. Peak did not set out to make a lot of changes to the code in this process. However, there was no intention for making change, but there were some areas where Peak recognized that were ripe for revision. And so those particular areas that were revised were only done so because Peak felt it was absolutely necessary. And anything that did include a significant change, they did go through the normal process for making those changes. Now, the new code follows the conceptual framework approach that most of us, I would imagine, in this room are familiar with. For example, we are now required to incorporate the identification of threats and the application of safeguards where we do identify threats. Now, of course, this approach is one that is only used when there is no specific language within the code itself. If there's something that's prohibitive in the code, you can't say, well, I'm not going to follow that because I'm going to find a threat and I think I have a safeguard to minimize it or reduce it to an acceptable level or perhaps even do away with it altogether. You can't do that. You can only use this approach when there is no specific instance of something not being permitted. Also, you'll see when you take a look, if you haven't done so, when you take a look, there are some areas in the back of sections where there's interpretations that you could see some boxes that now provide for some non-authoritative guidance. So I think that's another pretty helpful feature with respect to the new codification. There's an exposure draft online. Now, I think what you see on the screen here is the correct site on the internet. What was in your manuals is different. I actually went on last week, I guess it was, and tried to access and saw that the site had changed. So you'll have to change what it says in your manuals. It should read NJS, I'm so used to dealing with the society in their law and ethics class, www.aicpa.org/interest areas /professional ethics /pages /professional ethics .aspx. If you go there, you will find a PDF of the fully revised code, and you will also find a 5-minute video there featuring our own Ellen Goria. I watched the whole thing the other day, and boy, if she ever decides to get out of the accounting profession, she'd do a pretty good job, I think, as a reporter on television. She really did a nice job with this. 5 minutes is not a lot of your time when you get back to your office. If you could just take some time to sit down and go to that area, you can not only download a PDF of the exposure draft, but you could also watch this video. She did a really, really nice job. Okay, as far as your state's Code of Professional Conduct, I guess the question here really is, does your state have a formal Code of Professional Conduct? And if you do, does it stand by itself? If your board does have its own Code of Professional Conduct, does it parallel the AICPA Code of Professional Conduct? And if it doesn't, is there some reference in your regulations or, okay, there it goes. Is there some reference in your regulations or in your code to the AICPA Code of Professional Conduct? In New Jersey, for example, we have regulations that effectuate the statutes that govern the profession. As of this date, there is no reference in our regulations to the Code of Professional Conduct, but that is in the works. We are working on a few amendments to our regulations at this time, and that is one of the changes that we are planning to make. What we do in New Jersey is that where there is a regulation that requires certain action or inaction by the member or the licensee, you must follow that regulation. But where there is no mention of a particular matter, then the board will follow the AICPA Code of Professional Conduct. So that is how we tie in our regulations to the code. But as of this date, as I said, there is no reference, but we are currently making amendments to include that. Okay, the State Board Advisory Group. This is a group of individuals from the various state boards. Some of them are members, some of them are executive directors. They had a hand and dedicated some of their time to assisting in the drafting of the revised codification. Ray and I thought it would be a good idea to include this slide, again, that Ellen had given us just to give these people some recognition for their contributions to the process. Codification project is an excellent opportunity, whether you have your own specific code or not, to make changes and to try to bring your particular regulations and your code of conduct in line with whatever comes out after the exposure draft is completed and the new code becomes effective. You know, the more consistency that we can have from state to state, the better it is, I think, for all, especially with the concept of mobility out there. When you have people who are coming in from other states and really aren't, pretty much like the concept of mobility itself, it's why it's important that every state try to be consistent with their particular mobility law. If our regulations in my state are different than the regulations from your state with respect to a certain ethical matter, it just adds to the confusion. So I think it's really helpful if every board would sit down with whatever comes out from the final codification and compares that to your regulations or your individual code, whatever it is that you have in your particular state. We're currently in phase 3 of this project. As I said earlier, the exposure draft was issued on April 15th of this year. We have a comment period that extends until August 15th, and then sometime in the first quarter of 2014, it's anticipated that the code will be adopted. It is also anticipated that it will become effective after December 15th, 2014. There could be some exceptions for some of the broad conceptual frameworks that I had discussed earlier that may get another year to give firms adequate time to revise their policies and procedures. But as of right now, these are the plans of PEAK, and I'm sure that they're really looking forward to this time. So keep an eye on things. I'm going to give you a reference at the end of my talk here with respect to an area that you can go to online to keep up to date with this information. Why am I having such difficulty? There we go. Now let's get into the substance of changes just for a moment. Obviously, we could be here for an hour or two, but that's just not feasible. There are 2 new conceptual frameworks, as I said before, one for members in public accounting and another for those in business. One of the things you need to always remember is that when you are applying the conceptual framework, it's considered a violation of whatever the applicable rule is if you can't provide evidence that when threats were identified, that safeguards were applied to eliminate the threat or at a minimum reduce it to an acceptable level. If you can't provide evidence that you have followed the steps of the conceptual framework, then it's considered that you are in violation of whatever that rule is. So you need to recall that when you're dealing with these oh, I forgot to do this slide, darn it. Okay, let's get into the conceptual framework. When there's nothing on point in the old code, it was considered that it was permitted. That's not so now. When the code does not reference a particular matter, as I said earlier, you must apply the conceptual framework. Otherwise, you would be considered in violation. Here's a chart that shows the process of the conceptual framework. The first step is you need to identify the existence of any threats. If no threats are identified with respect to the particular matter, then you're good to go. Step 2 is if you do identify threats, then you have to consider whether or not these threats are significant. If they're not significant, then again, you're good to go. You can proceed. However, if you do identify significant threats, then you have to apply safeguards. There could be some existing safeguards that are out there for you to utilize, or there could be some new safeguards that are developed that would help you along the way. After you've applied the safeguards, then step 4, you have to evaluate the results of the application. And again, the idea here is to be able to reduce the threat to an acceptable level or to eliminate it in its entirety. They are the steps of the conceptual framework. I talked briefly about a substantive change report a few moments ago. Here's a copy of it. I thought you were going to get a copy in your materials, and I did not see it in mine. But again, when you go online to watch Ellen do her thing, you will see a copy of this there that you can download. It's only 6 pages long, but it gives you a detail of any of the significant changes that resulted. There's not a lot of them. As I said, it's only 6 pages long, so it's a good idea that you take a look at them. It's very easy read. So when you do go on to download your copy of the exposure draft, also download a copy of the of the substantive changes report. There's, in the back, in Appendix C of the exposure draft, there's a mapping document, and this is an excerpt from it. The idea here is to take you from the old existing citation for a particular matter and to get you to the new citation. It's sort of a roadmap between the old code and the new code. So when you do get a copy of the exposure draft and the final version, once it's adopted and implemented, go back to Appendix C. That will be very helpful in trying to get you from the old sections of the code that you're familiar with to the new. Pretty much like for those of us that have implemented the Clarity Project, there's similar type of aids in the auditing standards. All right, we've beaten up the project enough. Let's get on to non-attest services. There's a number of changes with respect to non-attest services. I think some of them may have really come from the GAO's changes that they made to the Yellow Book that were effective at the beginning of this year. And some of them were effective on August 31st of this year. I'm sorry, of last year. And let's cover those first. The first one is it addresses the period of impairment. If you've performed a non-audit service for a client, a non-attest client, that perhaps is a prohibited service, let's say, with respect to an impairment of independence, and that particular period in which you perform those services, the financial statements were audited by another firm, and now subsequent to that you become appointed to perform this test service for a future period, it would no longer be considered an impairment of your independence because you had performed these non-audit services in the past. So that's one change, and again, that's somewhat similar to what the GAO included in the new Yellow Book. With respect to communications, there's certain activities that are related to our test services. Certain communications are often considered a normal part of your attest engagement, and they really don't constitute a non-audit service. These would be things like providing advice with respect to the application of accounting standards, perhaps the proposed audit adjusting journal entries that you're providing to your client at the end of the service. These types of things are considered a normal part of an attest engagement and are not included in the definition of a non-attest service. And then lastly, they've changed the section that used to be called general activities. It's now management responsibilities. It somewhat provides guidance from the international standards, and all of this became effective August 31st, 2012. With respect to the outside scope of attest services, again, this is definitely a change, in my opinion, that was prompted by the GAO's changes. And it really deals, the best example is when you're preparing draft financial statements for your attest client. Always an area of concern. I have a partner who retired a couple of years ago that thought 1013 was just a total bunch of bunk. And he would get, I mean, you talk about being passionate. He was very passionate about it. He said that, you know, these are the reasons why a lot of our clients engage us. I just think they've gone out of control with this. I didn't necessarily agree with him. And he basically told me, he says, that's why I'm retiring. I just think we're over-regulating the profession. Well, that's not particularly the case, I don't think, but I think this recent change that they've made is a real good one, because now if you are drafting financial statements for your client, and that would also include cash to accrual services, and also preparing things like cash reconciliations. These services are now considered to be outside of the scope of your audit, and they would constitute the performance of non-attest services. I think that's a good thing, because it now creates, I think, a definite guide for you to follow with respect to how far you can go with respect to drafting financial statements. Where do you draw the line before you cross that line and you lose your independence? So if drafting financial statements now constitute a performance of a non-attest service, you have to apply the general requirements of 1013. That means, specifically, the client must agree to make all management decisions and perform all management responsibilities. They have to designate an individual with SKI skill, knowledge, and experience to have oversight responsibility of the particular service, in my example, the drafting of the financials. That individual has to evaluate the adequacy of the results of the service performed, and lastly, they have to take full responsibility for the service that you perform. This becomes effective as of December 15th, 2014. The last area with respect to non-attest services deals with those firms that are providing services, which would be internal audit outsourcing type services. And there's some clarity that was provided here with respect to services that were being provided on an ongoing basis versus a separate basis, where there was maybe just a separate evaluation that your firm was making. Simply stated, the new rule requires that ongoing services in this area do impair your independence. However, if you have some separate services, separate evaluations you're performing, not necessarily so. These revisions, again, are going to be becoming effective for periods beginning on or after December 15th, 2013. One other area that's not on our slides, actually Ray and I pulled it out, but there's been somewhat of a burning issue with respect to the cumulative effect of providing multiple non-attest services. This, again, has been put on the back burner by Peak for some more study, and so nothing has come out on that as of this date. All right, let's move into the area of holding out as a CPA. And what happened in this particular area is that the Peak basically deleted the holding out definition from section ET 92.12, which said any action by a member that informs others of their status as a CPA constitutes holding out. So if you have a business card, a letterhead, newspaper article that you've written, you refer to yourself as a CPA, you're holding out. The whole idea here is that by deleting this, the thinking was the board said, the Peak said that members should follow the code whether or not they are holding themselves out as a CPA. So that's a change that has taken place. In addition to this revision, they also expanded the definition of professional services to include services other than such as other attest services and business evaluations. These are now included in the definition of professional services. They also made a change of referencing what used to be called the practice of public accounting is now called public practice. And they changed the definition of public practice to simply be the performance of professional services for a client by a member or a member's firm. It says on your slide that this became effective May 30th, but while I was doing research and preparing last week, I did find that was a typo, and on the screen here you'll see it does say effective May 31st, 2013, so this is now effective. Request for client records. This is a hot topic at our board, and I'm sure it is in many of yours, and for a couple of reasons. I think there's confusion out there because the Code of Professional Conduct doesn't quite follow what our board has. My understanding, and I would not bet, I'm not a gambling man to begin with, but I would not bet on the total accuracy of this, but I have been told from reliable sources that out of the 55 jurisdictions, 33 of those jurisdictions follow the Uniform Accountancy Act when it comes to withholding client records. 10 of the jurisdictions are basically silent on the subject, and that leaves 12 jurisdictions which do follow the AICPA Code of Professional Conduct. I believe that the Uniform Accountancy Act says that you can never withhold client records for payment of fees. Now, that differs from the Code of Professional Conduct that says those client records which were completed by the member and prepared by the member on a completed engagement can be held for payment of fees when the client requests a copy of it, and for all other records where the client has provided to you, they must be given upon request. So here's the rule. As I stated, there's a majority of state boards have requirements that are more restrictive than the code. When a client provides their records to a member or a licensee, those records must always be returned upon request. Under the code, again, if a member prepares a client record and the service has been completed, the member must provide a copy to the client unless there are unpaid fees, but only if you're one of those 12 states. I believe that the other 33 specifically, and probably the other 10, would have to follow the UAA and could not use the fact that fees were unpaid for holding records hostage. That was a considerable debate at peak. It was one of my earlier meetings. It was somewhat divided as to those that wanted to follow the UAA. The compromise move here, to be honest with you, was to now include language right in the code that highlights the fact that members need to follow the state board's rules if they are more restrictive than the Code of Professional Conduct. So it now specifically states that right in the code. As far as members' work product is concerned, things like tax returns and compiled financial statements, et cetera, they should always be provided to the client upon their request. And of course, the members' work papers are our property. We're not talking about work papers like a depreciation schedule that is both a client record and a work paper, but those work papers that are strictly our work papers, they are the property of the member or the licensee, and they are not required to be given to the client. All right, subordination of judgment. The initial charge here is to take a look at 1024 and to determine whether or not it applied to both members in public practice and business. But that basic question really started what I think would call a complete review of 1024. This was completed at our last meeting down in Washington. The interpretation addresses differences of opinion between a member and his or her supervisor or any other person within the member's organization. That would include those that are in public practice or business, or whether or not they've been paid for the service, or whether they're performing the service on a volunteer basis. When there is a difference of opinion with a member and the supervisor relating to the application of any technical matter, a standard, a law, a regulation, etc., self-interest, familiarity, and undue influence threats under the integrity and objectivity rules may exist. So, therefore, you would have to apply appropriate safeguards if the member concludes that the difference of opinion creates a significant threat, just like I showed you on that flow chart. If the difference of opinion does not result in a material misrepresentation of fact or a significant violation of laws and regulations, the threats would not be significant, but the member should discuss the matter with the supervisor or some other person, whoever that other person is that's taking the position that is different from the member. Now, if the difference of opinion does result in a material misrepresentation of fact, so what do we do then? Well, in this case, the member should discuss their concerns with the supervisor, and if the matter is still not resolved to their satisfaction, then the member should consider taking those concerns to a higher level of management. If the member concludes after doing so that the appropriate action was not taken, then the member should consider safeguards to ensure the threats are reduced to an acceptable level. And even after the application of safeguards, if the member concludes there's no suitable, or the member concludes that there's no suitable safeguards, then the member should consider their continuing relationship with the organization. Nothing would preclude a member from resigning at any point in time from the organization. However, resigning, as pointed out, does not relieve the member of certain responsibilities, such as disclosure responsibilities to third parties. As I said, this was approved by Peak at the May 2014 meeting, and it becomes effective the last day of the month, and with the revision is published in the Journal of Accountancy. I still don't know what date that is. Probably will be sometime this summer. Jason, do we know that date yet? Jason? Jason's looking, he probably doesn't know it. So just be on the look at it. It will be advertised, or not advertised, but published in the Journal of Accountancy, and it will become effective the last day of the month that it's published. Partner equivalence. This revision deals with an attempt to identify members who, through their actions, could be considered to be partners in their organization. And you can see from the bullets on the slide various instances where this could happen. For example, the authority to bind the firm, with respect to an attest engagement without some other partner's approval, who has the ultimate responsibility for the engagement, who's signing off on the engagement at the end, who has the ability to sign the name of the firm, who has the authority to issue the report. These would all be instances where an individual is really the equivalent, acting in the equivalency of a partner. It's to be applied for purposes of determining independence, not intended for ownership matters. And a partner who is, an individual who is considered to be a partner equivalent is subject to the same independence standards as a partner would be. This is effective for periods that are beginning on or after December 15th, 2014. And last, client affiliates. This is another one of those independence issues. Raises the question about whether independence requirements should be applied to interests and relationships that a member in a firm may have with affiliates of a client. The new rules identify 10 different types of entities that could be affiliates, broken down into two major groups. These would be traditional entities such as subsidiaries and parents, and non-traditional entities such as an unregistered investment company and benefit plans and sponsors. What the interpretation requires is that when a client is a financial statement attest client, members should apply the independence provisions of the code that are applicable to the financial statement attest client to its affiliates, with some exceptions, but for the most part, they would apply them. This section is effective on January 1st, 2014. And that takes us to the end. I have a slide here that says any questions. I think we're holding questions till the end of the day. I think somebody said, but let me give one other little plug here if I could. There is an electronic document called Ethically Speaking. I hope you've all seen it at some point in time. If you have not seen it, you can go onto the AICPA's website, same site that I showed you earlier. If you go onto the Interest Areas tab and select Professional Ethics up in the upper left-hand corner, you can click on News and Publications. And then again, you will see an Ethically Speaking newsletter that comes out several times a year. This is a great way, probably a good idea to make an electronic version of it and send it to the members of your firm to keep them up to date on what the changes in ethics are. We have so many changes out there in what we do. It's hard to keep up with all this information, and if you are the ethics compliance officer, if you are not and you have one in your firm, you may want to make them aware of this newsletter. I think they really do a nice job of keeping people involved with what the changes that are going on at Peak. So with that, I thank you for this opportunity. Don't tell Ray that I did a lousy job, whatever you do, because he'll never give me a chance to speak again. All right, thank you.